You read the market perfectly. You spot the setup, execute your entry, and watch the price move exactly where you predicted. But instead of taking your profit, your momentum suddenly halts, as if an invisible anchor just grabbed your account and yanked it backward. If you are a high-frequency scalper, you know this exact pain. The market hits your 5-pip profit target, but your trade refuses to close. You sit there waiting for the exit to trigger, and before it does, the price reverses, turning a textbook win into a loss. This friction is the spread tax. It is a markup applied by the broker that acts as a toll booth between you and the actual market, demanding a cut before they let your trade through. Look at the math on this over time. Taking 20 trades a day with a 1-pip spread means you are sacrificing 400 pips every month. For high-frequency strategies, this leakage is unsustainable. Operating in a zero-spread environment is a mathematical requirement for the strategy to remain viable. To stop that leak, we have to look at how prices are delivered to your screen. There are two distinct execution environments: the standard market maker and the electronic communication network, or ECN. A market maker intercepts the global market price, widening the bid-ask gap to ensure their profit. An ECN acts as a digital bridge, matching your order directly with Tier 1 banks competing for the best price, dropping the spread to absolute zero. ECN brokers earn their revenue through a fixed dollar commission rather than a spread. To trade effectively, you must learn to convert that dollar amount back into pips to find your true break-even point. If a standard lot pip is $10 and your broker charges a $7 commission, you divide 7 by 10 to find a true cost of 0.7 pips. Compared to a standard 1.2 pip retail spread, you save half a pip on every trade. A visible commission is mathematically cheaper than the hidden compounding cost of retail spreads. Let's run a definitive A/B test on that pound-dollar scalp from earlier, applying both execution models to the same price movement. In the standard account, overcoming a 1.5 pip spread means the market must move 6.5 pips to secure your 5-pip profit. The zero spread account allows you to exit exactly at 5 pips, capturing profit while the standard trader waits for the gap to close. Removing this buffer allows you to set tighter technical stop losses based on the chart, rather than adding extra pips to account for a wide spread. Tighter stops permit larger lot sizes for the same dollar risk, directly increasing the geometric growth of the account's equity curve. Cautionary tone. Seeing 0.0 pips on a screen does not guarantee that your entire order will fill at that price. Due to depth of market, there may only be 5 lots available at the zero spread price. Placing a 50-lot order instantly consumes those lots. The remaining 45 lots slip into the next available prices in the order book, especially during thin liquidity events. Be wary of brokers who advertise zero spreads but use artificial latency to fill you at worse prices, or those who use high stop-out levels to liquidate accounts during minor price spikes. Trading with raw pricing requires ultra-low latency execution to be effective. Without both, the math of your strategy falls apart. Shifting your strategy to account for these daily micro-costs turns execution into a tightly controlled professional variable. Treating execution costs as a measurable factor allows for more precise risk management and more predictable results over hundreds of trades. To see exactly how much you are losing to spread leakage, download the FXNX True Cost Calculator and audit your current broker's performance. It is time to trade on professional terms. Access genuine 0.0 pip spreads and Tier 1 execution with the FXNX NX1.